the administration's Build Back Better plan hit a significant roadblock before the holidays. What does that mean for CFOs and tax chiefs? I know that many of them were preparing for a 15% minimum tax. Others were planning for an excise tax on buybacks. What does the delay mean for your clients and for CFOs overall?
Well, Nina, delighted to be with you. And so what it means right now is at least we have certainty as we start the calendar year. So many companies right now are focused on their financial statements. They will use the Jobs Act tax law as the basis to do their tax calculations. And they continue to watch what happens on the Hill because right now the Democrats are saying that they plan to bring it back before March. But there's a lot of focus on whether or not that will happen and would it go retroactive or be prospective. So more to come.
Brian, how is that with Xcel Energy? You're an energy company based in Minneapolis and Minnesota. How would you as a business fare under this 15% corporate minimum tax? Do you already know if your taxes would go up as part of this?
Oh, good morning or good afternoon, Nina, depending on where people are, and great to be here. You know, that's you're right. It's a good question, something we focused on very intently over the past about 4 months since it kind of pivoted from a higher corporate income tax rate to a book alternative minimum tax. And for us and really our industry, it's really call it case specific or company specific. For us, we have to look at the overall Build Back Better package. And in the book AMT is one component of it. And in isolation, the book AMT would result in a higher cash taxes paid. But as a clean energy company, we're one of the leaders in the clean energy industry in terms of wind deployment, moving into solar deployment. There are tax credit extensions related to the call it clean energy production that also come with a direct pay provision that allows us to cash those credits, turn those credits into cash, and that is helpful from an overall cash impact. So when we look at it overall for our company specifically, we actually see a cash flow benefit over our 5-year forecast period when we look at the entire bill. The book AMT, as I said, does have a cash impact, but we assess it, talk to our investors and analysts from the overall bill as we see the clean energy credits have a lot of support. And are hopeful that they get passed as we, as an industry and as a country, make the transition to a cleaner economy.
Sounds like your company is one of the lucky ones that could potentially see a positive impact, which is, of course, not always the case when we're talking about new taxes being introduced, as many of our CFO colleagues who are joining today will certify. Kate, Brian was just mentioning the book income tax element of the minimum tax, which we've heard from experts in the industry saying basically that there's a problem if one uses pre-tax income as a base to calculate the minimum tax. What have you heard from your clients on this? And do you share some of the concerns that people have around using the book income part?
Yeah, the book income part on the domestic side on the minimum tax is an issue for some clients that maybe have big bonus depreciation or research and development expenditures, depending on how they're treated. That can be an issue for them. So there is some concern. I mean, it's a complex alternative minimum tax on the domestic side that we haven't seen before. So again, everybody is looking for more details so that they could digest it. And so a lot of companies really are looking for more details if it in fact goes forward. There's also the 15% tax on the international side, which is a big concern as well.
Yeah, that's actually one of the next points that I had would have gone to you for, given that this 15% global minimum tax is, of course, part of the overall efforts from the OECD to revamp global taxation rules as part of the so-called Pillar 1 and Pillar 2 initiative. Maybe you can update us on where those projects stand, given that 2022 is supposed to be an important year also, not just on the US domestic tax front, but also on the global landscape.
Well, the tax community certainly got some amazing holiday gifts from the OECD. We got the detailed model rules on December 20th, and then the European Union came out on December 22nd with their directive, which really pretty much closely models the model rules. And so you can imagine a lot of time during the holidays has been spent by tax practitioners around the world reading them and digesting, and we're getting a lot of early reports. What's interesting is sort of the stagnation of the Build Back Better rules or that proposal makes the U.S. Being aligned to what the OECD wanted at question, because the current rules in the Jobs Act on what we call this top-off tax are not in alignment with what the OECD wants. And so there are some adjustments. And so query, even if Build Back Better doesn't go forward, would some of the international provisions come forward to be compliant with the OECD's requests?
Brian, how's that for you? Do you have a view on those potential global tax changes? I know that you're a fairly domestic business, but just wondering in how far you see any implications on Excel going forward as part of these global tax rule changes.
Yeah, for us, we're entirely a domestic company, operated our operations in 8 Midwestern and Western states. So really focused on the domestic provisions as we think about it. Certainly pays some attention to international, but it is not really applicable to us as a fully regulated domestic company.
We were mentioning talking about the 1% excise tax on buybacks that is part of the Build Back Better plan. From your perspective, Brian, as a CFO, when you think about returning funds to shareholders through dividends, potentially looking at buybacks, and how far would such a 1% tax on buybacks impact your decision making with regards to what's the best way for Excel to return funds to shareholders?
Yeah, it's certainly just putting on the corporate finance hat, right? Anytime you call it the cost of returning money to shareholders could have impact on decision making. No, for us, we're Excel, but also our industry, we're very capital intensive in a period of significant investment that is, generally outstrips our cash from operations. So we're generally an issuer in the capital markets, significant on the debt side, and also periodic equity issuances. So generally, our industry is looking more at has been issued dividends in terms of returning capital to shareholders, and we're expected. A lot of our shareholders expect the dividend yield that we provide. So when we look at it that from a dividend perspective, we expect to continue that. But certainly from just the overall CFO hat, anytime you change the equation or add increased costs to one way to return money to shareholders, that'll impact the decisions going forward about how companies approach it.
Kate, what have you heard from your clients on this? I know that, of course, for some companies, they just buy back shares because they have a lot of cash to distribute based on the pandemic and the strong earnings that we've also seen in recent quarters. But other companies, of course, do also buy back shares because they distribute a certain amount of new shares to their employees. So basically, they're just buying back shares to reduce the dilution that they would see in their stock. What have you heard, Kate, from clients on this buyback proposal?
Well, Nina, I've heard a couple of things. I think first, we're in a situation right now where the business community is anticipating there's going to be new taxes. This would be an example of a new type of tax, an excise tax on stock buybacks. I think with every country around the world revenue starved, there's an expectation that we're going to see new types of taxes. So I think that's one. Two is I think the business community feels that at least there's a choice on whether or not you do a share buyback. It's calculatable. You know what the cost would be. And so there's certainty to it. It's not revenue scored for a big revenue raiser. And so in general, it's not the biggest provision that there's the most concern about. I'm not saying there aren't some that, would be vehemently against it. But on the whole, it's a provision that I don't think has created as much communication and distress in the business community.
How about that proposal to make changes to interest deductibility? One of the plans the Democrats have been advancing in recent months is the idea to limit the amount of interest that companies can deduce for debt that they're raising. Have you seen companies already making changes to their debt structure, or is it too early for any specific changes?
Well, one of the provisions of the Jobs Act that is being impacted this year is the interest deductibility was based in the earlier years of the Jobs Act on what we call EBITDA, depreciation and amortization is the DA. So we have a lot of clients that are concerned because as part of the Jobs Act, that DA goes away this year and interest is now deducted on EBIT. And so there's a movement called, Bring Back the DA. And so some of our clients would like to see that happen. Clearly, that is, a lot of discussion in the Build Back Better proposals on this topic as well. And so it's a big issue. I mean, a lot of companies, but I don't think anyone right now is taking action on Build Back Better proposals. I mean, I think they're trying to digest them and then assess the likelihood of whether or not it goes forward.
Yeah, I think that's probably a good a good way of dealing with it, given that there's been various delays and it's not clear yet where things will be headed and if the bill finds support at all. Just wondering, Brian, if you're thinking about your industry, you were pointing out earlier that your company benefits from various clean energy tax credits. What is the expectation for you in terms of how long these tax credits will be available? And also, how are you thinking about potential new taxes that are being introduced if we're thinking about carbon taxes as global regulators and also politicians are basically looking for ways to reduce emissions going forward?
Yeah, we're paying very close attention to the clean energy provisions. The current provisions, primarily for solar production and wind production, generally phase out over the next few years. Solar extends a little bit beyond, but they phase out. And in this bill, there's a 10-year extension of not only the solar and wind tax credits, but there's also new tax credits related to clean energy. One is to support the nuclear industry. It's a very important source of carbon-free baseload electricity in our country. And if we think about moving to some of the administration's goals in the mid-2030s and beyond about being carbon-free, nuclear is an important piece of that. The other couple pieces are really around hydrogen and the production of what we call green hydrogen as really help jumpstart that sector as we think about how do we transition not only beyond, call it 80% carbon reduction as an electric utility sector, but even beyond that, and how do we make sure that we do it in both a reliable and affordable manner for our customers. And then there's some tax credits around storage, which is important as we think about particularly long duration storage down the road when we need to store, not just a few hours of electricity, but days and weeks when we think about a running an electric grid that is based much more on intermittent sources such as wind and solar. So something we're paying very close attention to, important as a sector as we think about our goals as a sector and as a country where we want to achieve. On the carbon tax, or really, call it a clean energy or a carbon tax, or depending on how you want to frame it up. I think the devil is really in the details. There had been some discussion around that in the fall, no longer in the Build Back Better in a form around a clean energy standard. But that devil really is in the details in terms of how you allocate it, how you develop, how is it implemented by the states. So I think one of those, similar to Kate said on some of the other, the tax, the design of the tax, it's really that the clean energy standard is really important to understand how it's going to be implemented, what's the starting point, and then you go from there.
Thank you. Kate, how is that with you? Sort of what are your clients' expectations with regards to carbon and other clean energy taxation rules going forward? And also, I was wondering if you've got a sense as to, assuming that the Build Back Better plan makes its way through Congress, sort of, and how far it would impact corporate deal making, so on the M&A front.
Okay. Well, first on the carbon taxes and the whole area of sustainability, I don't think there's a tax department around the world that's not leaning in and really understanding their company's strategy and what's going to happen. And the complexity that this is adding, because almost every country, going back to where countries are as a result of the pandemic. They're all revenue starved. This space lends itself to new taxes that can come in and really bite margin of companies that are manufacturing, distributing around the world. And so whether you're wrapping your goods in plastics, there's a whole new plastic tax regimes in Europe. And you know what, one of the mechanisms that has got a big focus on is the carbon border adjustment mechanisms in Europe as well, as being maybe a front runner of schemes that might really incent companies to get more decarbonized. And then also, countries or manufacturers that are not decarbonizing would be penalized if they import goods in, very simply. It's pretty complex. And so you can imagine, just again, there's a lot of concern about who's going to monitor all these taxes, who's going to stay on top of it, and how do you do that effectively yet continue on the sustainability journey that most companies are taking. So that's kind of where we are in sustainability, a lot of work ahead. And then secondly, on the M&A side, this, I think, will be one of the largest years for M&A activity that we've ever seen. I know we've been tracking it as to when does it become the largest activity. I don't see any end in sight. Companies are looking at interest rate hikes and cost of capital, and there's so much pressure to continue to grow. Clearly, the tax bills, right now, if it stays as the Jobs Act, that's a pretty business-friendly tax proposals. Obviously, there's still winners and losers. I'm sensitive to Brian, but I don't think that the business community would stop the inorganic side if this law stays constant. And I think it's hard to tell what will happen in terms of proposals right now. I think there is a lot of concern about the 15% taxes around the world and all of that getting implemented, mainly from a double tax perspective, just again, because these rules are so complex. So again, I still think, though, we'll see a lot of inorganic activity even as we go into 2022.
Just one follow-up question before we actually come back to Brian for our final question. But on the Kate, on the carbon border adjustment projects in the EU, what is the timeline on those? Like, when would those take effect? Do we know?
No, it's something that in COP26, the U.S. administration had asked Europe to kind of slow this down, and so those proposals are being taken back up in the EU now that there's a re-emphasis of the Paris Agreement, and so now I think we'll see this shape up. Like I said, there's a lot of complexity. I think first order of business was getting the OECD BEPS Pillar 1 and Pillar 2, the directives out on that. And then I think it'll turn to sustainability. And so we'll see what's the time frame. But we're looking at a couple of years out. But I think companies are going to need that time, Nina, to get organized if this goes forward.
Yeah, I guess you're right. None of this, of course, can be, it's not a switch off of the light, basically, with which you introduce any of these changes, especially if you're an international or multinational organization. Brian, just turning to you before we wrap this up. You were saying earlier in terms of the Build Back Better plan, the corporate minimum tax, that you were expecting potentially, if this is passing, you would expect a positive impact on cash flow. Just wondering if you're thinking about that positive cash flow that you would generate, and how far would that impact your priorities for spending? And as you're thinking about cash, we have a session on cash and CapEx spending later, so I thought this would be a good way of getting us to that topic later.
Yeah, we spend about $5 billion annually in our capital investments, and so when we look at the Build Back Better, it's that whole picture again with the book alternative minimum tax, but then coupled with the clean energy tax credits and what we call the direct pay provisions, which are really important to the clean energy industry, because what that does is it removes some tax inefficiency and removes the need for tax equity in some instances. What ultimately that increases, when you remove that tax inefficiency, you lower the cost of renewables, which is good for our customers when we think about affordability. As I think about the Build Back Better in general, it would reduce, when we look at it in its entirety today as it's written, we'd say it would significantly reduce our equity financing needs over the next 5 years. But also when we look at, we have our plans to reduce our carbon emissions by 80% by 2030. Some industry leading plans. Maybe with some incremental tax credits for new technologies, you could move faster. So you could potentially look at deploying additional CapEx here in the next 5 and 10 years. Because we think about when we work with our stakeholders in our utility commissions, we do focus on customer affordability and the impacts on our customers in this transition. So this type of support for the clean energy industry could mean we move faster on this generation transition, which means more capital investment for on our side.
Just talking about this 5 to 10 year CapEx spending plan, like without any positive impacts from the Build Back Better plan, what would you look to spend on CapEx during that time period, just so that we get a sense?
So I think our current 5-year plan is about $26 billion that we'll invest across our 8 states. That's in distribution, transmission, clean energy projects on our gas LDC side. Also, significant investment on electric vehicle infrastructure. That's one of the things that we're working on with our states is how do we incent the adoption of electric vehicles and make it easier for our customers. And there are tax incentives in the Build Back Better related to electric vehicles. So we spend about $5 billion annually without the Build Back Better in our current plans.